variable rates in the last 30 years have outperformed fixed rates by 88% of the time. The exceptions to that were obviously 2022, 2023 with 475 basis points of rate shocks hitting the market.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
So 2025 has got off to an absolutely crazy start. We all have to admit it. We thought we were going in for 25% tariffs, then 10% tariffs, and then, no tariffs. And then last minute, we're back. There's tariffs. That's right. You heard it. There are tariffs and they are back. But aside from all of that, we have the beginning of what people were calling the mortgage renewal cliff or mortgage renewal crisis. And it's beginning, and it is beginning hot with the amount of people reaching out to me on a weekly basis with mortgage renewals coming up being an absolutely insane number, which obviously we're happy to support, but a lot more than you would actually expect. There's a lot of uncertainty in the air. And to be quite frank with you, it's typically the people who have the mortgages up for renewal that are the most nervous about what's going on, less so than those who are looking to get pre-approved or purchase a property. Regardless of that, the reality at the end of the day right now is that people are having to make massive financial decisions about their future right now in one of the most uncertain economic times that we've had since, well, I guess it's only been a couple of years, hasn't it? We've had a pretty tumultuous last 5 years in the marketplace, and it looks like it's going to remain that way. And if you want to have a better understanding of how to approach a mortgage in this kind of a market, stay tuned to this entire episode because that's what we're going to talk about today. And it's because the question keeps coming up over and over and over again. What do I do? How do I make a decision? Now, there's no way for me to offer a customized approach for someone listening to or watching this particular episode, but it's important for us to recap it. And I'm going to do a YouTube video to break this down in a more specific manner, but let's just recap and talk about what's going on. Here we are, February of 2025, and we're still here trying to figure out as a homeowner, as an investor, or someone looking to renew or refinance, what do I do? Do I go fixed? Do I go variable? What's the best term length with the historical data that's going on right now and today's economy? And realistically, how do all these crazy ass threats from Mr. T down below the line and the United States and inflation and rates going down affect Canadian mortgages in 2025? All right. So by the end of our conversation, I hope you have a better understanding of what the heck is going on, or at least are trying to understand why people are struggling to advise in this type of a market. Now, I wouldn't say that we're struggling to advise, particularly on my team, because we use fundamentals. But I've heard that most people in the broker space and the banks are just going to defaults, which I don't think is the right approach, especially as it relates to your mortgage in this current market. But let's recap what's actually happening right now as of this episode in February 2025. The current Bank of Canada's overnight rate has already dropped a quarter point since the beginning of the year. And it's possible we might even see that happen in March of 2025. Now, inflation itself was running pretty hot. As of January 2025, it was running at 3.1%, which was down from 4.8% in 2024. But this is still above the BOC's target, depending on which measure of inflation that you're actually looking at. So again, things are trending in the right direction, but not where they need to be. The Canadian bond yields have looked like an absolute yo-yo in the last week and a half. And no doubt that's because of what we've seen happen from the, hey, we're going to have tariffs to, hey, no, we're not going to have tariffs to, hey, we're going to have them again. And it looks like that could continue to happen over and over and over again as the market tries to figure out where to put its money in these really crazy, uncertain times right now. Now, the U.S. policy is the major wild card of what's going on right now. As you guys know, the economy and the trade policies heavily influence where rates will go in Canada. With Trump back in office, obviously, we're already seeing these tariffs come back and forth. And as of February 10th of 2025, there will be a 25% tariffs, regardless of what was literally just agreed upon a week ago. we are going to see 25% tariffs on all steel and aluminum going from Canada into the United States. And while that's nothing like what we would have seen if it was everything, and we're not going to see the same impact of the GDP, it is notable. And the question mark around that is, do we see retaliation? And again, how does that affect the market? But that's not for today. Let's talk about how to make a decision. Why does this matter? First and foremost, tariffs could push inflation higher, first of all, which is not good for rate cuts. Retaliations can also impact what happens here. And a US slowdown could drag down the GDP, which could actually be good for rates to come down. Okay, regardless of all that, let's go into the big game, fixed versus variable now. What does the data say? Because that's all that really matters when you're trying to make a decision. Historical data. Do variable rates typically win? So if you were to look historically speaking, variable rates in the last 30 years have outperformed fixed rates by 88% of the time. So 88% of the time, which is quite interesting. The exceptions to that were obviously, as you know, 2022, 2023, with 475 basis points of rate shocks hitting the market like a mofo. And 1978 to 1981, prime hit 22.75, which was obviously the worst time to have a variable rate mortgage. So if you felt bad in 2022, that's why your parents always talk about the early 1980s and rates hitting 20%. Now, that world is gone and past, but the reality of the marketplace is all we can do, again, when looking at these things, is to try to understand history as it relates to trying to determine the future, especially in uncertain times like we have right now. Now, as of today, variable rates are still just ever so slightly higher than fixed rates, by the average being around 0.25% or less, depending on the discount that you're getting. Now, insured mortgage rates, which is when you're putting less than 20% down or you're transferring insured mortgage, will be closer to fixed rates than uninsured. Uninsured is a 20% down, over $1 million purchase, 30-year amortization. Those will be a little bit farther apart, a little bit more in the favor of the fixed as far as the spread, but they're all pretty much within 0.25% right now of each other. The question that most people want to ask here is, when is the best time, historically speaking, to take a variable rate? And I've got some of my notes here. Most of the stuff I could speak off of memory. For the sake of conversation, I noted it all down here. So historically speaking, if you're just trying to understand history of rates, nothing else, just looking at the history of rates and you're trying to figure out what was it or what is the timeline I should be working with. When prime is above its 5-year average, which it is right now, when inflation is improving, which it is right now, and when the Bank of Canada stops hiking rates, which happened about a year and I guess a quarter ago, which 2023. So we are in that prime window as far as the historic benefit or time that you would want to take a variable rate. When was the best time to take a fixed rate, historically speaking, when prime is below its 5-year average, which it is not quite yet? When inflation worsens, which is not currently happening right now, and when bond yields spike. Now, we saw this happen in 2022 and 2023, but we're not seeing that happen right now, even though the bond yields went down, up, and then they've recently come back down again. They're not spiking up, and the trend line still continues down, which is essentially where the trends are looking right now. All right, so 2025. This is the year that everyone thought that, BOC was going to continue cutting rates and fixed rates would continue dropping. And although it's kind of happening, it's maybe not happening in the way that some expected. We will see fixed rates come down a little bit because the bond yields have come down almost 0.3% in the course of literally less than 30 days. But the banks are adding in what we call risk premiums. And if you want to understand that more, I did a complete episode literally 3 weeks ago about why variable rates were actually kind of going up in a sense, as opposed to going down, and why the discounts were going away. Anyways, you're going to see banks, even though they want to be competitive, they're going to have these risk premiums because of what's happening in the marketplace to kind of pad their margins and make sure if things go sideways, they're fully protected. So let's talk about the term selection in 2025. You got the shorter term, 1 year to 3 year fixed, or variable rate. Let's go through that. This is best if you think that rates are going to go down within the next 1 to 2 years. Okay. If you plan to sell, refinance, or move in the next 2 to 3 years, then it's probable that you should consider the short term or the variable rate. And if you have strong cash flow and you can handle rate fluctuations, if you're any of those people, then that term length would make a lot of sense for you to consider. One second here. So I did make a note here from an example perspective. On the 2-year fixed rates right now, somewhere around 5.5% to 5.25% with many lenders, while the 5-year fixed rates are much lower in the low fours. The premium for the shorter term could pay off if we saw rates drop in 2026, and if there was a possibility or likelihood that you may benefit from the perspective of, that life change, that refinance, that equity growth, that whatever that is, right? Now, on the longer term side of things, if you are going with a longer term fixed rate, it's best for somebody who really just wants payment stability. Absolutely no surprises in their life. Things just want to continue on as they are. No stress, regardless of what tariffs come, what tariffs go. You just want to be able to chill, relax, and enjoy life without thinking about your mortgage for a little bit. That is the person who's looking at that longer term fixed rate. Now, if you also have higher debt service ratios, so if your percentage of debt relative to the amount of mortgage you're borrowing is in the higher side, like you cannot deal with any payment fluctuations, also probably ideal because of the fact that you'll have that certainty in your financial situation as well. And then also, if you're, and this is kind of a thing that's counterintuitive to what I might say otherwise, but there could be a value proposition for somebody who's doing this for an investment property purely from an understanding of exactly knowing where their cash flow situation is over the next 5 years. Now, what I would argue to that is that you would want to be really, really careful that you don't have any intentions to break that mortgage in the term, refinance, restructure, sell that property, try to pull equity, anything like that that could happen, or change your mind if that were to happen. And liquidity would be low, which means you could pay a huge penalty if you were to get out of it. Now, we've talked about the third option before, which is the hybrid mortgage. And, for those types of mortgages, it's basically where you split up a fixed and a variable rate. You can do a 50-50, 25-75, 40-60, whatever you want. And it's only available with particular lenders and particular products. But those would be good for those who are, the type of investor who wants diversification in their portfolio. You want to know that you've got one egg in this basket and one egg in that basket. Maybe you're somebody who's self-employed, you want to play the markets, but you've got a fluctuating income, something like that, where you just have unpredictability or a sales role. In that kind of world, you might have a good year and then a bad year. It might be worth putting, half of that into certainty and then the other half into flexibility. And then the last one is maybe you've got a first-time buyer who just can't make the decision. Should I go fixed or variable? And of course, trusty mom or dad will just tell them whatever they want to default to. Well, this means that you could kind of benefit from both sides of the coin. Now, realistically speaking, if you do the hybrid option, you're kind of protected against a portion of your money if the rates go up, but it allows you to benefit from interest rates continuing to go down if that were to occur in the situation. Now, let's talk about some of the biggest risks in mortgages in 2025. So one of the things you really have to be careful of, or what are some of the risks and what are the things you have to be thinking about getting into this mortgage situation here? So the first one is something that's not a surprise or nothing new, but it needs to be thought about and considered, especially as it relates to a declining rate environment, which could be the case over the next 1 to 2 years, depending on how you think about the current rate environment. And that big one is the one that we call the IRD penalty. So fixed rate mortgages, they carry something called an interest rate differential penalty. And this prepayment penalty could be 4 to 5 times bigger than your typical variable rate mortgage. Essentially, it's like a prepayment penalty that is a recapture of the potential money that bank could have made if they sold your mortgage otherwise, or if someone else obtained the same mortgage at that interest rate. Those little buggers can cost you an arm and a leg, and they will come out and get you, especially in a declining or flat rate environment as we see term lengths change and we see posted rates continue to change. There's a lot to it. Maybe I'll do a future episode where we talk about prepayment penalties. It's a bit dry, but I do have someone I can bring on to go into depth about that particular factor. The second thing you want to think about is the fact that, like, the average 5-year mortgage, like the average person breaks a 5-year mortgage at 3.8 years, which is statistically shown. And if that is the case, and if that's reality, then you're for sure paying a prepayment penalty. And then you're rolling the dice as to whether or not it's 3 months interest at, $3,000 on 200 grand, or if we're talking about $15,000 on $200,000, that's a huge difference when it comes to your day to day. Your renewal risk is another factor you have to be careful. So if rates were to spike at your renewal, of course, as you know, you could be left with a higher payment like what we're seeing happen right now. So on one side, rates could go down in the next 2 years. If the alternative were happen, you could, of course, see your payments go up again. So it would have gone up from 2020, I guess, to 2025 and then to 2027 if you did take the 2-year term. Again, I think 25 to 27 could be a sweet spot for mortgage renewals if rate cuts materialize, and that could benefit the variable rate holder and the short-term mortgage holder as it relates to different rate options if the economy goes on its current trajectory, and that's assuming things don't dramatically change. The other thing to think about is like just portability. So if you think about banks like Scotiabank and TD and RBC and some of the others, some of the banks have great conversion policies and some of them do not. And there are many situations where I've seen people who get stuck into different types of products that they didn't expect or having to have multiple components that they didn't strategize for, which could end up costing you more money. In fact, I'm working with someone right now where they had 5 different components at all different terms and they felt stuck because essentially the bank really didn't offer them favorable terms in any of those new mortgages, because whenever they had one going on, if they wanted to get the other one out, they would have had to pay a prepayment penalty to exit the other mortgage. Now, that's not always a bad thing, but having a strategy and advisory service on that is really, really key. The other thing to think about is if you're going with these mortgages, are you going with a fixed payment variable because you could have a payment shock if you took a variable rate if rates went up, or an adjustable rate, which is obviously a key consideration to make sure that your payments are always paying off principal at the same amount of time. Although the downside is that if rates go up, of course, your payment goes up with it. So you need to be able to have that flexibility with that budget that we talked about previously in the conversation. So a lot of information today. We've got these tariffs going on, man. I don't honestly, it is like day to day trying to figure out what's going on. Trump is what they call a bad character. Like, he doesn't negotiate in good faith. It appears that things that he say may or may not be impactful or matter. And I don't want to get political about it. It just seems like day to day, there's different things being said. And those different things that are being said are certainly having an impact on the economic environment that you and I live in, which is impacting our day-to-day lives. So how do you deal with this? And should you buy real estate in this market? That'll be a trend that we'll continue talking about in the coming weeks and in our YouTube channel series that is going to go even bigger on these topics. The first one is, what do you do? Okay, so if you want the flexibility and you think rates are going to fall, you're going to go short term. You know, short term, 1 to 3 years, and you're going to go variable. Like, that's it. If you want stability and you can handle today's interest rates, then you're going to go with a 5-year commitment. Now, I didn't talk too much about the amortization periods, but that's another factor that you need to consider, especially as it relates to the possibility of any payment shocks to you today. Like, you can amortize your loan over a longer time frame, like 30 years instead of 25. For some reason, people seem to think that 25 is the maximum. I'm not really sure why, but that is the way it is out there. If you're really not sure, or you want to hedge your risk, then the hybrid mortgage could be the winner for you to consider as it relates to your mortgage. But here's the thing. The bottom line is that your mortgage term selection is not about guessing. It's not about listening to grandpa or uncle. It's about a clear strategy that is based on data and the knowing factors. Now, there are other tangibles at play. What do you qualify for? What does your credit allow? What timeline do you have? But ultimately, if you were to try to consider a few of these factors that we talked about today, it should make it easier for you to narrow down the type of product that you want, so that when you're talking to your mortgage broker professional, you can let them know where you're leaning and they can ask you good questions to make sure it's still a good fit, and then sign you up with the right product that you should be set up with midterm to long term, depending on your situation. So again, strategy is key as it relates to all these decisions. Now, the real question is, what happens with these tariffs, and do we counteract, and are you buying a home this year? So listen, if you found this valuable, hit that subscribe button, hit that like button, leave me a review on iTunes, leave me a review on Spotify. I'd really appreciate it, and I'll see you on the next one.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.